Joining us now, ahead of the inflation data, Citi economist Veronica Clark. Veronica, it's good to have you
Good morning.
this morning.
Thanks for having me.
I was just saying how I just feel like I'm in limbo or something about this number too. It's not Trump's number yet. Is it Biden's number? Is there anything in it other than, I know eggs are expensive, and I know
Yes.
it's hard to buy a car now, or it's expensive to buy a car.
Yeah, this will be an interesting one, but certainly not going to tell us anything about Biden or Trump or any of that. So the last couple years, this January reading has been a pretty interesting one, just because we've seen this start of year strength in inflation data. We saw this in a really big way last Q1. So the big question is, are we going to get those start of year price increases just as strong this year? And I don't think we will. I think that will show us that there is less inflationary pressure than there was over the last couple of years.
What's the is it always oil, or what is it that dictates whether we're ready for some type of period of higher inflation we're expecting?
Yeah.
What do we need? What should we be watching for? What's the alarm bell?
Yeah, in the details of this inflation data, where we've seen that residual seasonality show up is really in services prices. So for medical services, transportation, recreation, I think it's just reflecting that wage costs have gone up a lot over the last couple years, and it's the start of the new year, and those service providers are raising their prices. So that's where we've seen the residual seasonality in the past. But I think a really important driver of inflation this year, which has not been the case the last couple years, is that we do see components like shelter inflation slowing. That's related to housing and rents. And that does finally seem to be catching up with market rents that have been slower for a while now.
So you're expecting a friendly number for the markets?
It will be stronger than the last couple months, but the key question is it stronger than last January? And I think it will not be. I think there will be some slowing in inflation this reading, yeah.
So what do we figure that the Fed, when they look at CPI, they've got their own way of measuring inflation. Where are we right now? 2.5?
Yeah, I would say, the measure that the Fed targets most is core PCE inflation. Right now, that's at 2.8% year on year. I think realistically, we are something like around 2.5 to 2.5 range. And if Q1 is not as strong this year as it was last year, that annual number will look a lot better in a couple months. It will look like 2.5.
And 2 to 2.5 is almost where we want to be.
Yeah, essentially. I do think inflation has slowed a lot. And for that reason alone, the Fed can be cutting at least a couple times this year.
Yeah, because 2 to 2.5 isn't 2.5. It's 2 to 2.5.
It's close, yeah. Yeah, it's close to target, yeah.
So that means what for cuts this year? You think in when?
We have still a very outlier call on how much the Fed is going to be cutting. We think 125 basis points of cuts. Yeah. I think we can get something like 75 on slowing inflation alone. I can easily see June, September, December quarterly. If inflation is slowing and policymakers think rates should be around 3%, there's still a long way to go. But I would be worried that the recent stability we've seen in the labor market is not as durable as maybe Fed officials think it is.
So you see some slowing then?
Yeah. I don't think we certainly haven't seen it in the labor market data recently. I don't think we'll see it for maybe another couple months. But I would be worried as we get to the spring and summer. A lot of the rise in the unemployment rate has been driven by businesses not hiring, and I have not seen evidence that that has changed.
So you would say that the risk now is on that side of it, not inflation.
I think a lot of the narrative is around stickiness to inflation, and we'll see how true that is today, of course. But I think there's a lot of reasons, that shelter component, to be optimistic on slowing inflation. And there's, of course, a lot more ways that the Fed would be cutting than hiking, I think. Any weakness in the labor market would do that.
I think that the stock market then would be happy,
yeah,
even though if we'll trade some.
Depends on the conditions that get us there.
For our 125 basis points in cuts.
Sure.
Especially if the jobs are government jobs that you're seeing the shortage.
That could be part of it. Yeah.
Because the government jobs were always the ones that were kind of keeping things steady.
Yeah, government employment has been very strong, but that is still going to be people who lose a job and are not spending in the economy. Of course, that's still going to slow things down.
It is, but it's probably a little different in the psyche, particularly if some of those jobs are people who have said they want to retire.
Potentially, yeah. It depends on maybe how they show up in the unemployment rate, if someone's just leaving the labor force altogether. But yeah, it will come down to that unemployment rate. I think the Fed gets uncomfortable if we're seeing something like 4.4, 4.5%.
And with none of the what would you even call what's happening in Washington? I don't even know what to call it, but none of
uncertainty.
None of that is playing into any of your. I mean, a slowing economy and weakening inflation doesn't seem to take into account the worst case scenario that we're told about.
Right, right. We're not expecting the big disruptive tariffs or the big mass deportations or really substantiul cuts to government spending. Partly because they would be pretty disruptive.
Yeah, your hair is not on fire. It's very nice. It's fun. Yeah, it is. It's definitely not even a spark. I don't think.
Yeah.
Anyway,
we'll have to change our forecasts, our assumptions for fiscal many times, I'm sure.
Okay.